In order to get things simplified, you need to know what accounts you should have and what the role of each account is. First type of account that you need in retirement is a high yield savings account. Now, the purpose of this account is to provide an additional cash buffer should an emergency occur, but not to have it sitting in a checking account earning almost no interest. As a rule of thumb, you'll want to have about 3 to 6 months of expenses in savings. So let's say you spend $10,000 per month. You want to have anywhere from $10,000 to $20,000 in your checking account, and then another $30,000 to $60,000 in a high yield savings account. Now, some people also like to purchase CDs, and that's not a bad idea. However, I'd keep it to no more than about 6 months of additional expenses. Second account type is a taxable brokerage account. Taxable accounts allow you to own investments like stocks, bonds, mutual funds, and ETFs. And even if you're someone who's risk averse and don't want to own stocks, you can still own conservative investments like bonds or bond-focused mutual funds and ETFs inside of your taxable brokerage account. And even these more conservative investments are likely to yield more than your savings account over time, and you can do so without taking on a lot of market risk. But if you are comfortable taking on more risk, then the taxable account will provide you with more long-term growth potential than your savings account just can't match. So let's say you have $500,000 in a checking and savings account at your bank. A better alternative would be to keep $100,000 in checking, savings, and CDs and invest the other $400,000 into your taxable account with, say, a moderate risk level. Long-term, this strategy can make a big difference on the amount of growth that you'll see on your after-tax savings. An additional benefit of a taxable account is that the investments inside the account qualify for what's called a step up in basis. That just basically means that when you pass away, your beneficiaries will inherit the investments for what they are worth at the time of your death, not what you paid for them. The third account type that you should have is a tax-deferred account. These are the most common form of retirement savings in the United States and include things like traditional IRAs, 401ks, 403bs, among others. Many people have multiple former employer accounts like this, and it can be complicated and overwhelming to have them in multiple places. Fortunately, these can be consolidated into a single traditional IRA through a rollover. For most people, this is the backbone of their retirement savings because that's what's been made available to them through their workplace retirement plans. And while tax-deferred accounts aren't perfect, the power of tax-deferred growth is still compelling and certainly has a place within your overall retirement plan. The next account that you should own in retirement is a Roth IRA. Unlike a traditional IRA, a Roth IRA is funded with after-tax dollars. And that distinction is incredibly important because with a traditional IRA or 401k, you're always sharing the account with the IRS when you withdraw. You just don't know exactly how big their share will be until you start taking money out. But with a Roth IRA, you pay the IRS up front, and what's left belongs to you. And that's what makes Roth IRAs one of the most flexible accounts that you can own in retirement. Another advantage of a Roth IRA is that there are no RMDs or required minimum distributions that will be owed during your lifetime. So if you don't need the money, you can just let it continue growing tax-free. The fifth account that you should own in retirement is a health savings account, or HSA. An HSA is essentially a dedicated healthcare retirement account. Most people know that healthcare is one of the biggest costs that you'll face in retirement. You factor in insurance premiums, deductibles, prescriptions, dental, vision, and long-term care. These things can really take a chunk out of your retirement savings. And to add insult to injury, these costs tend to rise disproportionately as you age. So in a well-structured retirement plan, an HSA can act as a buffer for healthcare costs, so you don't have to pull extra income from taxable or retirement accounts at the wrong time. And when used properly, an HSA is one of the most tax-efficient accounts in the entire retirement system. That's because they have what's called a triple tax advantage. First, your contributions go in tax deductible, so you get an upfront tax benefit, similar to a traditional IRA. Then once the money is in the account, it grows tax deferred. Again, in this sense, just like a 401k or traditional IRA. But here's where it gets really good. When you use the money in your HSA for qualified medical expenses, withdrawals are completely tax-free. So if used correctly, you get the upfront tax advantage of a traditional IRA and the tax-free withdrawal advantage of a Roth IRA. Now, one thing many people do is they keep their HSA money invested and then they pay their medical expenses out of pocket. This allows the HSA to keep growing. Then later in retirement, you can reimburse yourself tax-free. And as long as you have the receipts, there's no expiration on when you can reimburse yourself. This little known trick can help you keep more of your money invested over time and helps you reduce your lifetime tax bill. Not too bad, huh? Finally, once you reach age 65, HSAs become even more flexible because you can still use the money tax-free for medical expenses, but if you need to use the money for non-medical expenses, it simply becomes taxable income, similar to a traditional IRA without penalty. That means there is very little downside to having an HSA in retirement because at worst, it behaves just like another tax-deferred account, and at best, it provides tax-free money for one of the largest expense categories that you'll face during retirement. Having each of these accounts in retirement will help keep things simple and not overcomplicate your retirement. So if you found this video helpful, please like and subscribe so that you'll see more of our content and it will help other people just like you find our content. Thank you so much, and I look forward to seeing you in the next video. Hi, my name is Justin Haywood, President and CEO of Haywood Wealth Management. And if you're interested in learning more about how we help our clients live their life to the fullest, visit us at haywoodwealth.com to learn more. Thank you so much.